Okay. Good morning, everybody. Hope we're live. Looks like we're good. All right. I see some folks coming in. So good to see everybody. Good morning. Good Tuesday morning. Today is March 7th, 2023, and I want to welcome you to the Tuesday weekly webinar. So we're going to follow the same format. We're going to talk about the some IRA distribution questions and updates via information we get from the Ed Slott Group. We're going to go over some market activity and market returns. And then we're going to talk about our financial planning topic for today, which is a big one. So today we're talking about the national debt and the effect on your retirement plan. I'm just checking to see, because this is still new. I'm just checking to see if everything's okay. If any of my folks watching this for me are texting me saying, "Hey, can't hear you. Oops, can't see you," etc. So that's why you see me looking down. All right. I want to remind you, if you're listening to this or via podcast or on YouTube, please go to our YouTube channel and subscribe, like, and hit that notification button so that you're notified when these are set up and ready to go. So let me just see if somebody can throw me a chat. I can see and hear you okay. That would be great, just to make sure that we're running as we should. I appreciate that. All right. So I want to talk about some things that we have going on and what we've been doing recently. So if you joined us last Wednesday evening with what seems to be now an annual conversation with David McKnight, I really had a good time. I hope it was beneficial to you. We chatted for some time, a little over an hour, and Dave shared with me that he's going to release segments of that over his YouTube channel as well, of that webinar that we did. But, we talked a lot about the concerns that we have with government spending and the national debt and Social Security and Medicare. We're going to dig into that more today, but Dave's always a great resource to have. And I encourage you to subscribe also to Dave's YouTube channel and listen to his podcast. I try to listen to it every week. And if I don't listen to it every week, I catch up. They're only about 15 minutes long and certainly worth it. We've got Dave visiting us along with my mentor, Ed Slott, who, really is a thought leader also in the IRA planning arena. And in fact, the Wall Street Journal calls Ed the IRA expert, the United States IRA expert, something like that. But they think he's, thanks everybody. I appreciate you letting me know everything's good. So we've got Ed and Dave coming to Newtown Theater in Newtown, Bucks County on May 16th, starting at 6:30. That'll be a great event. We've got some classes starting in a couple weeks, maybe in 9 days actually. So starting next week at Holy Family University. So March 16th and 23rd, they're Thursdays. This is the way these live classes work, and actually the webinar classes as well. It's a series. So with the exception of a Saturday class, I'll talk about that in a moment, but we do 2 Thursday evenings and 2 Tuesday evenings. So the reason for that is some people are available Thursdays, some people are available Tuesdays, but if you can't make that second Thursday, you can jump in on that Tuesday class, or if you need to stagger it, you can do that. I hope that makes sense. But it's right at Holy Family University, just across the street from us at the office here. And it starts at 6:30 p.m., ends at 9:30 p.m. So it's 3 hours of instruction each night, so 6 hours altogether. And that's Tuesdays, 3/16 and 3/23. So March 16th and March 23rd. And then Tuesday evenings, it's the same material. March 21st and March 28th. Now, we just finished a class from Villanova, so we've got a whole new group of people who are starting to listen to these webinars. So if you received the invitation for this class, it is the same class that you attended in Villanova. Of course, you're welcome to take it again. That's fine, as long as there's space. That we do. One of the great things with webinars is there's really no cap to space. We can have up to 500 people on Zoom, but, I don't even know what it is on YouTube. I think it's unlimited. But with our classes, we are capped. Now, there is one Saturday class in this series, and that's on March 18th. That runs from 9 a.m. to 2 p.m. That's 5 hours, of course. So we did have to pull out the estate planning section. What I did last time for the Villanova classes, I sent the estate planning video so that people were able to watch that anyway and catch up, because I think it's such an important topic. All right, so we talked about upcoming classes. We talked about our webinar last week with Dave, and we talked about the upcoming David McKnight and Ed Slott event. And I told you today, for our financial planning discussion, we're going to talk about the national debt and your retirement plan. And it is 10:04, so Chairman Powell probably started his discussion with Congress. So we'll see what happens after we sign off today, where the markets are and what they said, and what he said. All right. So let's get into the slide update. So I'm going to share my screen here with you so you can read along. All right. So you should be able to see my screen. So the first section comes from Sarah Brenner. So you all know Sarah from the Ed Slott Group, and this is about naming a minor as your IRA beneficiary. So Sarah writes, if you want to leave an IRA to an adult, you simply name that person. So if you can find my cursor, I am right here. So I share this with you so you can read along, as you all know. If you want to leave your IRA to an adult, you simply name that person on the IRA beneficiary form. Unfortunately, when it comes to minors, it's not that easy. When a minor inherits retirement dollars, the child is not legally able to make financial decisions. A guardian may be needed. Guardians could be named in a parent's will, and some IRA beneficiary designation forms allow nomination of a guardian. The court can also appoint a guardian, but this can be a long and expensive process. I'm on this paragraph here. Another option is to name a custodial account for the minor on the beneficiary form. Custodial accounts established under either the Uniform Gift to Minors Act, UGMA, or the Uniform Transfer to Minors Act, a UTMA, depending on state law, can be used for this purpose. The IRA owner also names a custodian of the account on the beneficiary forms. Hope that makes sense so far. For IRA owners with large balances who want to control more after death, naming a trust established for the benefit of a minor beneficiary can be a solid strategy. However, the rules for the RMDs from inherited IRAs to trust beneficiaries can be complex. The Secure Act and the proposal regulations maintain the look-through trust rules that existed under prior law. If a trust for a minor child of the IRA owner meets these requirements and the child is the beneficiary of a conduit trust, then RMDs can be stretched over the child's life until age 21, when the 10-year rule will then apply. So I hope you all got that, because there'll be a little quiz on this. And of course, I'm kidding, but I chose this letter for a couple of reasons. First of all, it's great information. It's not talked about often. We do have folks who come in and say, I want to name my grandchildren, children, minor children, whomever, as beneficiaries. And we have to have this conversation that while you can, in some instances on the form, name a child, minor as beneficiary, at some point, you shouldn't, first of all, even if it's allowed on the form, but because at some point it's going to get skewed because the minor can't make financial decisions. So these are two really good options that Sarah talks about, the UGMA or UTMA accounts. That's a good option as well. And then to have a more complex option is the trust. So first of all, as I said, I think this is good information. Secondly, it just goes to show you that this is complex planning, complex issues that should be left to your planning team, who do all this work for you and report back to you, and all work together to make sure everything's running as it should for you. So that is Sarah's report for today. Oh, and she goes on to write, you work a lifetime to build a legacy. When IRA dollars are intended for a minor, proper planning before death by naming UGMA or UTMA account and a custodian or a trust can help assure a safe passage of wealth to a younger generation. Nice wrap up, Sarah. But get your team involved. This is complex stuff. And, I just love it. I had a client who scheduled an appointment with us, his CPA and his attorney. I think it was last week at this time during this call. And he apologized and he said, hey, I forgot that you were, you do your webinar every Tuesday, but one of my staff members, Emily, our senior planning associate, was on that call. And I reviewed the notes and talked to Emily quite a bit after, but this is exactly how it should work. The client came to us all collectively with a question. Here's what I want to do. Here's what I'm thinking. We all came together and said, here's the best way we think to structure it, and kind of brainstorm different ideas. That's how it should work. It shouldn't, no one should make these decisions, these complex decisions, in a vacuum. So that was, I like it when things like that work as intended. So this is from Andy. So this is the mailbag. The mailbag is when people write in and they get their questions back from the Slott Group. And these can be folks like yourself, individual consumers, investors, IRA holders, etc. Or often it's financial advisors, CPAs, and attorneys. This is not an exclusive group. You've heard me say before, the Ed Slott Group. It's unfortunately, it's treated that way by many professionals who choose not to dedicate the time, the resources to have the constant education that Ed and his team offer. And I really appreciate it. If Ed's listening, I really appreciate it. And so here's the first question. Can an education savings account be rolled into a Roth IRA under the recently enacted Secure 2.0? 529 plans clearly can, beginning in 2024, but I've found no reference to education savings accounts. Can you kindly clarify this and direct me to any literature? So with some limitations, the Secure Act 2.0 after 2024 has allowed for unused 529 funds to be rolled into a Roth IRA for the beneficiary. So that was a really good answer to these problems of, okay, now I funded a Roth, or a 529. What happens if child 1, 2, or 3 or any don't use that 529? What happens to those funds? And that's often a question about the amount of funding going into these 529. So this helps. There are some limitations, as I outlined, and we talked about it feels like months, it probably was months ago now. And you can view the video on YouTube. That is the Secure Act key elements, is what I think I called it. So this is asking about ESAs, education savings accounts, and Roth IRAs. So let's see Sarah's answer for Philip. So Sarah writes, I'm sorry, this is not Sarah. This is Andy. Andy writes, Philip, the new Secure 2.0 rule allowing leftover 529 plan dollars to be rolled to a Roth IRA effective in 2024 and subject to strict rules does not extend to education savings accounts. The law is specific to 529 plans only. However, there is a workaround. If the beneficiaries are the same, an ESA, education savings account, can be transferred into a 529 plan. Those funds could then potentially be rolled over to a Roth IRA under the new Secure 2.0 rule. Brilliant strategy. Again, this is why we have the folks at the Ed Slott Group. All is not lost. They can take that ESA rolled into a 529 and then potentially rolled into a Roth IRA with the restrictions under the Secure 2.0 rule. And by the way, it's not, I can't remember the name of the act, but it's not called the Secure Act, the Secure 2.0. It's called something else. But we all refer to it affectionately as the Secure 2.0 Act. Okay, next question. This is about another question about an inherited IRA. You hear this a lot because it's confusing, and it's gotten more confusing with the new rules. Every time they bring forth new rules for RMDs, they just complicate the matter. So it gets more confusing for required minimum distributions and inherited IRAs. That's why you hear this often. And it's important for you to hear, just to, if nothing else, for you to just reach out and ask us the question before you do anything with your inherited IRA. So here's the question. I have a new inherited IRA, and I believe that I'm subject to both the 10-year rule and to required minimum distributions, RMDs. Is this true? So here's their situation. Original owner was age 92 and passed of September 2022. So the original IRA owner was age 92 and passed in September 2022. The original owner was taking RMDs and took the 2022 RMDs in February 2022. So now, if you are a seasoned listener to this webinar, podcast, whatever you're listening to, then you should already be circling two things. You know, when I took my CFP exam, I would go through the problems and I would circle things. And make different marks by them. So I knew that these were key items. Key item number one on this is age 92. Well, even, that's well above the age 72 item that was first involved with the Secure Act, right? It took it from 70 and a half to 72. And then the second is the original owner was taking RMDs already and took the RMD. Now, not distributions, but a required distribution. That's a key item. And then they write, my brother and I, age 61 and 63, each inherited half of this IRA. The paperwork on this inheritance was not complete until January 2023. We are the sons of the deceased. So how do we calculate the RMDs? We need to take, if any, what balance do we use? Balance date it when? Whose age life expectancy do we use? When does the 10-year rule clock start for us? So many questions. Really, really good questions. What balance do we use? That's the first one. Balance date it when? Whose life expectancy or age do we use? When does the 10-year rule clock start for us? Really, really great questions. So this is going to be a bit of a longer answer. So the answer is, Mark, while you're, not me, another Mark, while your scenario seems complicated, it is typical to keep the answer as clear as possible. I've broken it down into bullet points. This is a really good reference for everybody to keep. So you should record this part and keep it forever. Yes, you and your brother are both subject to the 10-year rule. Yes, you and your brother are both subject to RMDs in year 1 through 9 of that 10-year rule because the original account owner was already taking their RMDs. Remember, Sarah came up with this brilliant thought that just is embedded in my mind. It's based on that Rolling Stones song, Start Me Up. Once you start, you can't stop. Start me up and I won't stop. I forget that. I guess I should learn those words, but never stop. Start me up, I'll never stop. But once those RMDs start, they can't stop. So if the original IRA account owner starts their RMDs, then they do when they can't stop with the non-eligible designated beneficiary when they roll it over. Yes, you and your brother are both subject to RMDs years 1 through 9 of that 10-year rule because the original account owner was already taking RMDs. I'm just going to slide this up. And I'm right here, bullet point number 2. Since the decedent passed in 2022, the 10-year rule begins in 2023. And the accounts must be emptied by December 31st, 2032. Remember, it's 10 years after the year following the year of death. RMDs are calculated using your own single life expectancy based on the age you will turn on your birthday in 2023. Your brother will do the same for his inherited IRA and his own age. So you can find this life expectancy chart on our website, AttleBoroWealth.com. Go to the slot corner. I'd like to give Ed all the credit for his great material, and you scroll down and you'll find the RMD with the life expectancy chart. You download it. It's got the single life expectancy on one side and the one that you use for yourself. That's what you use for inherited IRAs. And it's got the other that you use for RMDs on the other side. Using your age this year, identify the applicable factor from the single life expectancy table. This will be your starting factor to calculate the 2023 RMD in the year 1 of the 10-year rule. Now, subtract 1 from the original factor each successive years, 2 through 9. That's confusing. I understand it. Many, many financial advisors make this mistake. You don't go back to the table ever again with an inherited IRA. You figure out your original factor and then you subtract 1 each successive year. That's where a lot of mistakes are made with RMDs. For 2023, divide the original factor into the 2022 account balance. So his question is, what balance do we use? Well, Andy's telling us it's the end of the year, 12/31/2022 account balance. If the inherited IRA accounts or inherited accounts had not yet been established by that date, use 1/2 of the actual 12/31/2022 balance in the original IRA owned by the decedent. So now he's saying if for some reason that inherited IRA hadn't been established by the end of 2022, well, you got to use the account balance of the original decedent's IRA by the end of 2022. Use 1/2 because you and your brother are splitting the original account 50-50. That's why he's referring to the half. So that's a little confusing, Andy, but that makes sense, right? Because the person writing only is required to do the RMDs on 1/2 of the balance. Each year, subtract 1 from the previous year's factor, divide that into the previous year's balance, 12/31 balance, and empty whatever remains by the end of 2032. Another mistake I sometimes hear is people say, okay, well, we use the balance starting in 12/31/2022, and sometimes people do an RMD based on that balance only, 12/31/2022. That's not how it works, folks. The following year's RMDs had to be based on the balance of 12/31/2023. The following year's RMDs had to be based on the balance of 12/31/2034, and it continues like that. So it's not set in stone. Yes, that original factor is where you stay, and you subtract one, but that balance amount changes every year. Hope that all makes stuff. These are confusing things, I know. All right, now let's talk about the markets. All right, so we've introduced Cornerstone Portfolio Research. So this is a group we've been working with to help do some research on our own investments here and our investments for our clients. So they do a report every week, and I've been reading it, sharing it a little bit with you, but I'm going to incorporate it more into our strategy. And at some point for our clients, we're going to have a webinar where we're going to introduce Cornerstone, and we're going to talk about our updated portfolio models and all that exciting stuff. So they talked about treasury yields, again, grabbed headlines. The interest rates are going up. Interest rate yields on U.S. Treasury bonds are going up. And they talk about the 10-year Treasury pushing over the key 4% level. Short-term Treasuries, as I shared with you, have been well over 4% for some time. So that's that inverted yield curve we've talked about. So that puts some pressure on stocks. They write, Fed speakers have emphasized that further strong data will likely result in even higher interest rates. So we expect the volatility to continue with no strong trend in place until March data starts to show itself. So they go on to talk about unemployment, and they share this chart. I'll share it with you. Let's see here. I got to find my cursor. So it's they're looking at unemployment rates. So this goes, this is back to 1954, right? So here we are in 2020. Let me make this a little bit bigger, and that was the big spike. But we see this big drop in unemployment rates, and here we are in January 2023. So that's the report that they're referencing, just to give you a reference there. So so what they're saying, Cornerstone, is that unemployment is likely needs to rise in order for the Fed to pause. So unemployment still being very, very low. We're going to hear discussion about that from Empower also, but it needs to rise for the Fed to pause because they want to see those numbers increase before they really look at stopping the tampering, right? They use the rise of inflation rates to tamper growth in the economy. And as long as the economy is continuing to grow, less and less people are looking at unemployment, and they'll keep rising rates. Hope that makes sense. Because that's a big question. Big question on everybody's mind today is what's the Fed doing? At least on us, in this business. All right, it's a different report. But anyway, overall, the markets were up last week. But we had some uncertainty yesterday. My apologies. I usually go over the rise and falls of different areas of the markets, but I don't have that report, that snapshot this week. Let's talk about some of the other research reports. So there was a really good one in Seeking Alpha, which is one of my favorite research sites. You can join it. It's anybody, it's not just for us in the industry. But they wrote, the investors await Federal Reserve Chairman Jerome Powell's semi-annual testimony on monetary policy going on right now before the Senate Banking Committee later in the day for clues. This is written early this morning, for clues on the central bank's future rate path amid a wave of strong economic data. Powell will deliver the same testimony before the House Financial Services Committee on Wednesday. So Senate today, the House tomorrow. The Fed chief's appearance on Capitol Hill followed the release of central bank's monetary policy report. While the Fed eased its aggressive rate hiking campaign, recent data could mean a return to bigger rate hikes to rein in stubbornly high inflation. Markets are largely expecting a 20.25% rate hike at the Fed's March 21st, 22 meeting, according to the FedWatch tool, and have priced in the probability for higher for longer interest rates. Meanwhile, San Francisco Fed President Mary Daly said disinflation is far from certain, and the Fed is not done with tightening. So, as the question is, are they going to stay at 0.25%? Are they going to increase it again to 0.5%? Things are getting more expensive. Housing is getting a little more challenging. Construction is getting a little more challenging because you have to borrow money typically for those things. So we'll see what happens in the next couple of days. The economy, Wall Street Journal says the economy continues to be strong. So that is really creating a bit of havoc in this what's the Fed going to do kind of discussion. Because if the economy continues to stay strong, unemployment numbers continue to stay low, and with the action of the Fed raising rates, at some point you run out of bullets, right? What else can you do other than continue to raise rates, continue to raise rates, continue to raise rates? They've already tightened their monetary policy, which is they're not issuing as many bonds, buying back as many bonds. So, that's the other way that we loosen things. We loosen economic policy by reducing interest rates and putting more money out into the economy. We're doing the opposite now to help tamper inflation and economic growth, so it doesn't stay out of control, because we all can't afford this kind of inflation for much longer. So the folks from Empower, they write, pity the poor U.S. consumer, because it's starting to look like that's exactly the situation they find themselves in after a long binge on stimulus-fueled liquidity. They may be finally starting to feel the impacts of the long-feared post-pandemic hangover. Take this sampling of comments from last week's long list of retailer earnings calls evidence. So higher income consumers are trading down. That came from Dollar Tree. Consumers are more cautious and wary of a recession in the short term. That's from Lowe's. And elevated inflation is beginning to impact lower and middle income consumers. That's from Ross, and on and on. When most of the executive teams in the sector seem to be saying the same thing, they're probably trying to tell you something. When that sector's retail, they write, it's pretty easy to read between the lines. January's big surge in retail spending might well have been the last gasp of post-COVID party that probably went on too long in the first place. So a lot of people still have, some cash they've received, from the government or the state benefits or what have you. But some analysts are saying that's, that party's coming to an end. So you add all those things up. Nobody's really sure what's going to happen. Nobody's really sure why. We talked about this last week. Nobody's really sure why the Fed's actions, and they've been relatively aggressive, haven't really helped to dampen things. And we'll just have to see what happens. So again, what do we do? How do we manage this? You and I, our team, with your retirement funds. Well, folks, you've heard me talk about it a million times. Certainly financial planning, identify your needs, goals, and issues, but deeply identify those needs, goals, and issues. I get so frustrated sometimes when I hear these financial planning discussions and they're just on the surface. That's no good. You really want to shake those trees, figure out what your real costs are going to be for everyday expenses and aspirational expenses and the new roof, new cars, travel, just day to day. You got to really figure out what that is and not just put some false number on it. And it may seem like a real number to you, but when you dig into it, usually that's not the case. $10,000 a month turns into $14,000 a month, or $5,000 a month turns into $8,000 a month of need in retirement. And these are big differences. So you really have to shake out those trees, and you have to spend a lot of time in that plan before you come up with investment recommendations. And in my opinion, those investment recommendations should, of course, be based on the plan needs, but you use the principles of asset allocation, principal protection, and account segmentation. And gosh, if you could throw in guaranteed income for life, and if that could be tax-free income for life, boy, you've just covered most of the bases that you're going to need to make sure that you're set up. So that's how you manage these things. Don't get caught up in the micro. Pay attention to it. For crying out loud, yes, open your statements. Another frustrating thing I hear all the time is don't open your statements. When the markets are down, don't open your statements. When the market, first of all, open your statements every month. Review those statements every month, whether it's a click on your mouse or opening up your mail. Read them all the time. But certainly when the markets are down, certainly when you're losing money in your investments, these are the times that you should be having conversations with your financial advisor and discovering why that's going on, if it's happening in the expected areas of your investments. I say that because if we go to the bond holdings that were supposed to be our safe, I did air quotes for bonds, but it should be air quotes for safe, that were supposed to be the safe allocation of investments. Well, bonds were down anywhere from 3 to 18% last year. And most people weren't expecting that from their safe, air quotes, safe allocation. So make sure that you don't have to understand it as intimately and as well as we do, but you should understand generally if there's an issue, what happened and how it's being addressed. So pay attention to those things. All right, now let's talk about our financial planning topic. So I'm going to switch to my whiteboard here, and you're going to see me looking down because I'm going to draw on here. So let me just move my stuff out of the way and get ready for this. I'm starting to like the new YouTube format. I'll just say I did notice some big differences with Zoom last week when we talked when we had our webinar with David McKnight. But I'd love to hear feedback of what you think about the new format, the studio, etc. The studio is really kind of nice and cozy in here. Once I get in here, I have something on the door that says "Don't come in," but it's kind of nice just to be in here, and I hope it all sounds good and looks good. All right, so today we're going to talk about the national debt and your retirement plan, as we discussed. Now, just last week we talked about the U.S. Treasury report and the Congressional Budget report, but we focused on really Social Security and Medicare and some of those other topics that were affected by those or brought out in those reports. And of course, tax revenues and expenditures. But there was so much in those two reports that I said, okay, we're going to continue this discussion next week. But we're going to talk about the national debt. And in fact, I just added on here. So you would remember we went through all this last week, the future of Social Security, and how it related to the these reports. And we talked about the unsustainable fiscal path, and we're going to continue on with that. But there were some things that again we're going to touch on today, but we're going to focus on the national debt. And David and I talked a bit about this last week. So let's go through it. So the first thing I want to share with you, I'm going to drag this down, is the U.S. national debt clock. So if you go to usdebtclock.org, you'll see this. I don't know why that's sticking up there, but over here on the left here, if you see my cursor or my pointer, that's the current national debt, $31.5, almost $31.6 trillion. And this is really flying. You'll see these numbers. This is shocking, right? So when I put this number up for my class, you really can't take a snapshot of what the national debt is. Oh, I'm sorry. And for those of you just joining us on YouTube, please hit the like, subscribe, notification button. So we segment this out. I think you know. So we do the full weekly webinar, which is 45 to 50 minutes, sometimes an hour, depending on the topic. And then we do a section called the Financial 15. And the Financial 15, so you might see the same topic, but two different thumbnails on our YouTube page. But the Financial 15 is just a financial planning topic. So many of you are coming on just for the financial planning topic in the Financial 15. And it's not always 15. It's often a little bit more than the 15. So bear with us. But if that's you, if you're just listening to this, or just joining us, please like, subscribe, and hit that notification button. And if you are listening, what I'm showing is if you go to usdebtclock.org, you can follow along, and the national debt might be much, much higher than it is right now at 31.6 trillion. It just turned for us. Did you guys all see that? It just turned to $31.6 trillion. That's nothing to celebrate. And we just witnessed it, right? So $31.6 trillion solidly now and climbing, and you can track that at usdebtclock.org. And that's the U.S. national debt that we owe on the bonds that we issue. And we have to pay interest on those bonds. And we have to borrow for things now we didn't have to borrow for just a few years ago. The class I teach used to say that 96% of all tax dollars go to fund just four things: Social Security, Medicare, Medicaid, and interest on the national debt. And now it's 101%. 101%, which means that we are borrowing to pay for those things. And that leaves no extra money for any other program. You pick it. There's a lot of federal programs out there. National parks. I love the national parks. My family and I went to Grand Canyon, the Grand Canyon last year. Great, beautiful park. If you've ever been there, but that's one thing that's not being funded by tax dollars. It's funded by debt. Congress, the Senate, the White House, the IRS, the armed forces, all of the armed forces. There's just not enough there. So you pick it, any other program other than the ones we talked about. So we're going to dig into that a little bit more. There's a lot of material here. So let me move that back. All right. So you should be seeing my screen again. So that's the debtclock.org. We talked about that. So there are two government reports that recently came out in February. I talked about this last week that continue to sound the warning. And the one was the Financial Report of the United States from the U.S. Treasury Office. The second was the Budget and Economic Outlook 2022 to 2020 or 2023 to 2033, and that's from the Congressional Budget Office. So they both came out within, I think, about a week of each other, but maybe a few days. The Congressional Budget Office, I shared this with you last week, but I'll read it to you again, or you can join me in reading it. They said we have an unsustainable fiscal path. Not the first time that they've said this in their report. An important purpose of I'm going to read this section to you just to kind of tee up this discussion. So this is from the CBO report, and we're going to talk about the U.S. Treasury report in a second. An important purpose of this financial report is to help citizens understand current fiscal policy and the importance and magnitude of policy reforms necessary to make it sustainable. A sustainable fiscal policy is defined as one where the ratio of debt held by the public to GDP, gross domestic product, the debt to GDP ratio is stable or declining over the long term. GDP measures the size of the nation's economy in terms of the total value of all financial goods and services that are produced in a year. Let me repeat that because it's important to know for the rest of our discussion. So GDP measures the size of the nation's economy in terms of the total value of all financial goods and services that are produced within the year. And that is right here if you want to read it by yourself as I go along. So I'm underlining that for those of you who are just joining us or just listening. And of course, if you're listening, you can see everything if you log on to YouTube and view everything. Considering financial results relative to GDP is a useful indicator of the economy's capacity to sustain the government's many programs. This report presents data, including debt, as a percent of GDP to help readers assess whether current fiscal policy is sustainable. The debt to GDP ratio was approximately 97% at the end of fiscal year 2022. So let me read that again. The debt to GDP ratio was approximately 97% at the end of fiscal year 2022. So representation of our debt is about 92% of the goods and services produced in a year. Yikes. That's high already. Down from approximately 100% at the end of fiscal year 2021. That's a good sign, right? It's coming down. No, it's not really. This is a bit of a blip down. The long-term fiscal projections in this report are based on the same economic and demographic assumptions that underlie the SOSI. The current fiscal path is unsustainable. It says again that the unsustainable fiscal path is the headline. The statement in the paragraph here is the current fiscal path is unsustainable. To determine if current fiscal policy is sustainable, the projections based on the assumptions discussed in the financial report assume current policy will continue indefinitely. The projections are therefore neither forecasts nor predictions. Nevertheless, the projections demonstrate the policy changes need to be enacted for the actual fiscal outcomes to differ from those projected. Let me just adjust my microphone. Okay, I'm going to move that down a little bit because I'm looking down. I hope that's okay as far as sound. All right, so that's kind of the preamble to our discussion. So I hope that helps you understand this report and where it's coming from. Now, in this report, there was a graph here, and I'm going to show that graph, and there's another one like it. So you saw this last week, but I'm going to share it again. The debt to GDP ratio was approximately 97% at the end of fiscal year 2022. So we just read that. Under current policy and based on this report's assumptions, it is projected to reach 566% by 2097. So is that possible? Well, it's possible that we get there. How we fund it, is nearly impossible. But they write the projected continuous rise of the debt to GDP ratio indicates that current policy is unsustainable. Well, of course, you can't have 566% of GDP. And you see, here's where we are currently, right? We're right about here in this graph. And let me see, I didn't capture what these are, but here is spending, non-interest spending. Here they are. And here is total spending. And you'll see that and your primary deficit. But what you see here is this gap that's predicted to continually increase. Now, these are just current programs. These aren't, and this is not a political statement. These aren't proposed programs. These aren't the Green New Deal, and it's not Medicare for all, and it's not all the things that have been talked about. Now, I'm not saying whether they're valid or not. But this is talking about current programs that we have to fund today, and the gap that is quickly coming and already here, right, in the funding and what we have coming in. We talked about last week the difference, and I can shoot over there. I'm not going to do that actually, but the difference between revenues, our tax dollars, and expenditures, and it's a significant amount. So let's continue on. The U.S. Treasury report. Well, hopefully they say something different. Not really. So this is from the U.S. Treasury report, and here is the snapshot, the budget and economic outlook. It's called from 2022, or excuse me, I did it again, 2023 to 2033. So they write, federal debt held by the public is projected to rise from 98% of GDP in 2023 to 118% in 2033. So the last one, went out to 566% by 2097. And you're all thinking, oh, we're not going to be here by 2067 or 2097. What do we care? But, if you have grandchildren or children, you should care. But here we are at 118% by 2033. Again, unsustainable. An average increase of 2 percentage points a year. Over that period, the growth of interest costs and mandatory spending outpaces the growth of revenues and the economy, driving up debt. Those factors persist beyond 2033, pushing federal debt higher still to 195% of GDP in 2053. So 30 years, we're at 195% of GDP. In 10 years, at 118%. Now, that's if everything stays, the policy stays the same, spending stays the same. In my lifetime, I really haven't seen significant cuts in spending to affect it. And you've all heard us talk about, the experts, including David Walker, who have said, we either have to, and he said this in 2008 and 2009, we either have to cut expenses in half or double taxes or some combination of the two. And as you know, we've done exactly the opposite. So here's just another graph that shows here we are, right, in 2033 right here, and increased spending relative to GDP. So just not a great projection. And again, this is not any conservative workshop. It's nothing that wants to move the needle on any piece of legislation. These are the Congressional Budget Office and the U.S. Treasury sending out these reports, and they produce them every year. This is nothing new, and this is updated but not new information. Now, this group, the Peter G. Peterson Foundation, I've got a lot of information here, so let's try to keep with our time. I'm going to read you these. So we're here. Interest payments on the national debt were $475 billion in fiscal year 2022, so up significantly. 10 years ago, it was about $266 billion. Now, if it was, let's just use that number. And we talk about this in our class, $266 billion. I'm writing on the board now, compared to $475 billion. The national debt has increased 6 times, times 6 times. It's increased 6 times. But the payments on the national debt the interest on the national debt has not even doubled, right? And why is that? Well, it's because we've been in a low interest rate environment for the longest period of time, but that's over now. That ship has sailed. The train has left the station. Horses are left the barn. Whatever analogy you want to use, those interest rates are gone, at least for the short term, but probably for the longer term. Those low interest rates. So as interest rates rise, what do? Well, we've got to pay more interest on the debt that we owe to ourselves, our individuals, all this debt on bonds. That's why we're seeing these huge increases in debt, right? Or in debt payment. I'm sorry. That's why we haven't seen huge increases in debt payment over that period of time, even though the debt has increased. So 10 years or 20 years ago, that debt was just over $5 trillion and the payments were $266 billion. So again, a 6 times increase, 5 trillion to 31.6 trillion. But the debt payment hasn't even doubled. So look out, because interest rates continue to rise. And as our debt continues to rise, these interest payments have to continue to rise, right? Well, what are they? Last year, they were $352 billion. I'm sorry, 2021, they were $352 billion. In 2022, $475 billion. What are they projected to be in 2023? $640 billion in 2023 is what it's projected to be. And it's projected to grow 35% every year. All right. Highest, I'm going to read this to you. Relative to the size of the economy, interest costs in 2030 will reach 33% of gross domestic product, exceeding the previous post-World War II high of 3.2% of GDP, which was recorded in 1991. These are interest payments, not percentage of national debt. These are two different numbers. These are interest payments associated compared to GDP. Within 10 years, net interest costs will exceed federal spending on crucial programs like Medicaid and defense. Within 10 years, I'm going to repeat that. Net interest costs will exceed federal spending on crucial programs like Medicaid and defense. Spending for net interest will become the largest program in the federal budget within the next 30 years, outpacing spending on Medicare and Social Security. So within 10 years, we spend more on debt payments than Medicaid and defense. And within 30, we spend more on interest payments than anything else, including Medicare and Social Security. So now I'm going to share some charts and graphs from the Peter G. Peterson Foundation. Again, you can find this. It's not hidden information. You can Google it and find it. So net interest costs are projected to exceed the previous high relative to the size of the economy by 2030. So you can see here's where we are, 2023, and it continues to increase dramatically. Net interest as a percentage of GDP. Let's go on. Here's another one. Projections of net interest costs have grown worse over the past year. Net interest billions of dollars. So you can see here, 2023, we're right here. And these are the actual, and these are the CBO projections for February from 2023 compared to May 2022. So this is last year's projections, 2022. This is this year's projections. Holy cow, big difference. That's what they're trying to tell you. 10-year interest cost between 2024 to 2033, $10.5 trillion. Just last year, they were projecting $8.1 trillion. This next one, Congressional Budget Office projects that long-term interest rates will remain high while inflation and short-term rates will moderate over the next few years. So we're looking at the difference between the interest rates. So now I like this one here. Spending on interest will exceed spending on a number of categories over the next decade. So I don't like it, but it shows well. Fiscal year 2023, billions of dollars. You see here, it shows interest. Here's our standard line here. Interest, other mandatory income, security, Medicaid, CHIP, and premium tax credits, defense, Medicare, non-defense discretionary, and Social Security. Now look at the difference here. Fiscal year 33. Look at the increase. Social Security increases dramatically, Medicare increases dramatically, and interest comes out over top of that. So that's in 10 years. And remember, in 30 years, this line is going to exceed everybody. Very important. And by say, if you're just listening, I'm just drawing here. When I said this line, I mean the interest graphically. This one's staggering. Within 10 years, the federal government will spend more on interest costs than it historically spent on R&D, infrastructure, and education combined. Within 10 years combined. Federal government will spend more on interest costs than it historically spent on research and development, infrastructure, and education combined. That's staggering. Spending for net interest is projected to outpace other spending. So this is just showing the sharp increase in net interest. This dark blue line, which at this point, it's about 2043 outpaces Medicare, and about between 2048, shortly after 2048, I'm going to say, halfway, let's call it halfway between 2048, 2053, it outpaces Social Security. Net interest costs will account for almost 40% of federal revenues by 2053. So I think we have all the ammunition we need to talk about the fact that something has to be done about this interest problem we have, federal debt problem and payment of the interest. But the problem is that what's the government going to do? David and I talked about last week in our webinar that, and I talked about the courage. Somebody has to have courage in Washington to make changes to Social Security and Medicare. So just by saying that today, I could never run for Congress because somebody would pull this out and say, Mark wants to make changes to Social Security and Medicare. But let's be honest, folks, we have to make a change. And I'm not suggesting that anybody collecting Social Security and Medicare today has a change, but certainly future generations that haven't yet started relying on this income or benefits, we realize, and we should realize as a nation, have the courage to give our lawmakers courage to change this. But if that doesn't happen, we're looking at a couple of things. Many of you have seen this before. We referred to this as the intersecting line charts. So we spent a lot of time talking about the cost of interest. Cost of interest and national debt. So we know if this line represents revenue and this line represents expenses, we often refer to just Social Security and Medicare here. And now you add on our national debt. We know that Medicare now is scheduled to run out of money. That means the trust fund. So we're talking about trust funds. And these trust funds were established to help pay for the benefits, and at some point they run out, and there's only a percentage of the benefits that are payable. And the trust fund for Medicare runs out in 2035 as of the last report. Now, as of the last report, I'm sorry. That's not right. Wrong number. I was graphically, that didn't look right for me. 2028. Yeah, 2035 is too far away. 2028, right around the corner, within 5 years, that Medicare runs out of money. Now, we talked about the increase in national debt payments, interest payments within 10 years. And that continues to increase. And now we've got to look at, here we are, we're going to just call this, the point of no return, really, 2035, Social Security Trust also goes to zero. So 2028, $0 for Medicare and $0 for Social Security. So it doesn't mean Social Security is completely bankrupt. It means that I think the number is 72%, maybe as high as 77% if you include the disability insurance. But only 72 to 77% of those benefits are payable. So who's going to take that deal? Probably not many people. So we have to do something, and we're going to have to do something. And we think it is right around 2030. So I think government's going to come to us in crisis mode because I don't think we're going to give them the ability to act before that. They're going to come to us in crisis mode and say, we need to do something. So we go through these options. Of course they can cut expenses before that. So if we were in a live class, I'd say, raise your hand if you think the government's going to cut expenses to do this. And maybe one person would raise their hand for it, but it's not likely that they're going to do that. Number two, well, we could print our way out of this, right? There is a theory going around out there, modern monetary theory, that basically says we can spend all the money we want in our federal government because the government can just print money to cover what they need. So I don't agree with that. And I think it's been shown coming out of the COVID, it's been kind of a good test case for that, because We pushed out about $9 trillion altogether with our new debt and our quantitative easing and just funds to go out to individuals and businesses. And that's done a couple of things, but it certainly has driven up inflation for sure. So that's not a viable option. Well, we could borrow money, right? We could borrow money to fill those coffers. Well, that's part of the whole problem. Now we're adding on to the national debt and we're adding on to those interest payments. So that's not a real answer to it. And it just leaves number 4, which is raise taxes. So we typically, with this intersecting lines discussion, we talk about Social Security and Medicare, but we have to add in interest on the national debt because all these numbers that I went over with you, where we're in 30 years, debt's going to be more than any other government program. Within 10 years, it's going to be larger than Medicaid and defense. So I'm hoping it's peaking up your ears saying, we've got to do something about this individually if Washington doesn't do anything. And individually, you still have the opportunity to position yourself into things that are not going to be taxed in the future. We still have this window of opportunity between now, let's call this 2023. So we have this opportunity between now and 2030. We have this window to be able to start moving things into tax-free entities, Roth IRAs, cash value life insurance, properly structured cash value life insurance, Roth 401ks, et cetera. So any year that we give up that opportunity to do that, we expose ourselves to increased risk to just land here in this horrendous tax situation. And as we've said, on my estimates and the group I work with estimates is that your average middle class American is going to be in the 40 to 45% effective tax rate somewhere around 2030. So you got to take an opportunity to shift things from your tax deferred, your taxable bucket to your tax-free or tax advantage bucket while you still have some time, because every year that passes and this window closes, you have less and less time to do that, and it gets more dire, and it's going to be more costly as we move forward. Okay, so we've covered quite a bit today. It is just 11 o'clock or 10:57. We gave our slot updates. We did a market, some analyst reports, and a little bit of a market review. We went over these huge issues with the national debt. Really discussed a lot. Let me go back to my I gotta find my cursor. I'm so sorry. Oh, goodness, there she is. There I am. Okay, so we talked a lot about these national debt issues, and I hope I've given you enough information that really piqued your interest and said, okay, this is something additional that I really have to pay attention to. Maybe you weren't before. Maybe you're already tuned in and paying attention to that. I'd love to hear from you. Tell me what you thought about this webinar today or all the webinars. Stay tuned to other webinars coming up. I hope you're getting the notifications. I see those of you joining us today. Spread the word. Share it with your friends if you enjoy this. Hit the subscribe, notify, and like button on these videos, and I hope it's helpful. Even for those of you who are already in this process of shifting your money from forever taxed to, as my mentor Ed Slott says, never taxed, as I like to say, never taxed again. But if you're already in that process, I hope this kind of just shores up your resolve to get that done and continue working with it. If you're not in that process, give us a call. Let's talk about how we can do it for you, set up that strategy. And if I can't help you, we'll find somebody else who can help you. But you got to do something, folks. This train is coming, so you got to act on it. All right. That's all for today. We'll see you next week. Have a great week. Take care.